You are listening to Uranium Spotlight, your weekly podcast on the forces shaping the global uranium fuel market, sponsored by PurePoint Uranium Group. Uranium Spotlight isn't just a podcast, it's a platform. Visit purepoint.ca to access in-depth market briefings, sector analysis, and the inaugural Behind the Curve report, understanding when and how the uranium market turns. If uranium matters to you, you're in the right place. And now, your host, Chris Frostad.
It's July 14th, 2026, and this week on Uranium Spotlight, the spot market settles into its summer slowdown while utilities quietly keep the term market busy. India and Australia deepen their uranium relationship, raising new questions about where Western supply will come from. China tightens its grip on Namibia and lays out an ambitious reactor build-out of its own, and ATHA Energy delivers two discovery announcements in 2 days from its Angalac project in Nunavut. The spot market moved firmly into summer mode last week. The week opened at $84.95 a pound U3O8 and held near that level for most of the week. Monday and Tuesday passed with no reported transactions. Wednesday brought some off-market activity, but pricing barely moved. In total, roughly 500,000 pounds changed hands off-market, all for prompt delivery. Fresh bidding interest appeared on Friday at $85.25, and that's where the week closed. The weekly price indicator settled at $85, up 5 cents. The first half of 2026 tells an interesting story. The first quarter was busy with nearly 19 million pounds traded. The second quarter slowed to 11.6 million. A major factor was the Sprott Physical Uranium Trust. The fund raised over $680 million early in the year and purchased 6.4 million pounds through the end of April. Since May, it's added barely 200,000 pounds. When the market's largest buyer steps back, volumes feel it. Deal sizes are also shrinking, with the average spot transaction in Q2 coming in at just 90,000 pounds, a new low. The term market, however, remains very active, despite the season. One utility is reviewing offers for 500,000 pounds a year from 2027 through 2031. Another seeking up to 1.4 million pounds starting in 2028. Several more are running requests for information. The long-term price is holding at $94, with forward indicators sitting above $100. For investors, the key takeaway is that a quiet summer spot does not tell the whole story. Utilities are working the term market hard, and that's where the real demand signals live. India and Australia have signed new uranium supply deals, and the agreements are stirring activity in both countries. Australia's governments appear to be of two minds about the new demand. Officials point out that it can be met by Olympic Dam, and that's a reasonable claim. Although Olympic Dam produces uranium only as a byproduct of copper, it remains the second largest uranium-producing mine in the world. It single-handedly keeps Australia at number 4 among producing nations. The larger question is why Australia is not number 1, given that it holds the world's largest uranium reserves. The answer is politics. The federal government provides little support for uranium mining, and approvals are difficult to obtain. At the state level, uranium mining is banned in 6 of 8 states. The opposition sees an opportunity. In Queensland and in national parliament, opposition politicians argue that all levels of government should support more uranium mining. Even if Australia keeps its ban on domestic nuclear power, it can still supply the countries pursuing carbon-free baseload energy. That ban, it's worth noting, rests more on media-driven fears of accidents than on the industry's actual safety record. India, meanwhile, is moving quickly. It's set a goal of 100 gigawatts of nuclear power by 2047, the centennial of its independence. In March, the government signed a supply contract with Cameco of Athabasca Basin. Now NTPC, India's largest power utility, has issued tenders seeking uranium from Canada, Australia, and Kazakhstan. NTPC built its business on coal and natural gas, but it's expanding into renewables and moving towards nuclear. Large private Indian companies, some of Fortune 500 scale, are issuing tenders as well. All of this new demand is arriving in a market where global uranium requirements are already projected to rise substantially over the next several years, while supply falls or at best holds steady. That leaves an uncomfortable question for the West. The United States and the European Union together operate more than 200 reactors. The U.S. produces roughly 1/5 of its own uranium needs, and it is yet to announce new supply deals with any country. If India secures Canada and Australia pounds, the remaining pool gets smaller. For investors, the key takeaway is that sovereign demand is now competing directly with utility demand for a limited pool of Western supply. Each new tender from India shrinks that pool further. part of the reason the U.S. appears stalled is that uranium is increasingly sold along alliance lines. Many producing countries now sell most of their output to their diplomatic allies, and Africa has become a key arena where East and West compete for resource contracts. This week, the focus is Namibia. Namibia is the world's third largest uranium producer, having passed Australia a few years ago. Ownership, however, tells its own story. All four of the country's operating mines have some level of Chinese ownership, and two are Chinese-owned outright. That relationship deepened this week. The Namibian president completed a state visit to China where the two countries agreed to expand cooperation in nuclear energy and uranium. China will build Namibia's first reactor, and the two sides also agreed on uranium supply. One detail is worth highlighting. Namibia has no facilities to convert, enrich, or fabricate fuel. For its own reactor, it will depend on a partner, most likely China or Russia, for every downstream step. That dependency effectively locks even more Namibian supply into China's orbit. China will need it. Beijing announced this week that it's targeting 110 gigawatts of nuclear power by 2030. That means adding roughly 20 gigawatts per year for the next 3 years. At a standard 1,000 megawatts per large reactor, the scale of the Westinghouse AB1000 and its Chinese and South Korean derivatives, that works out to about 20 new reactors a year. Those designs matter because China and South Korea are currently the major exporters of reactors around the world. Westinghouse, it is worth remembering, is owned by Cameco. The supply chain implications are significant. China's build-out will absorb large volumes from Kazakhstan, Namibia, Niger, and beyond. That leaves Canada and Australia as the West's primary sources, and as we just discussed, India and Europe are competing for those same pounds. The U.S. risks being left short. For investors, the key takeaway is that the uranium market is divided into blocks, and the Western bloc's available supply is shrinking fastest. That's structurally supportive for Western producers and developers, and a growing security of supply concern for U.S. utilities. This past week, ATHA Energy issued 2 press releases in 2 days, both from its 100% owned Angalac project in Nunavut. On July 8th, the company announced a new high-grade discovery at Lac 50 Northwest, located 4 kilometers along strike from the existing Lac 50 deposit area. The second hole drilled there intersected 11.5 meters of composite uranium mineralization, including 7 meters of continuous mineralization averaging nearly 8,000 counts per second. Within that interval, 1.6 meters of high-grade material peaked above 40,000 counts. It marks ATHA's 6th regional discovery in Angalac in 15 months, and the company reports a 100% success rate on its 3D inversion targets. On July 9th, ATHA followed with the results from Rib North, the follow-up to last year's discovery there. The program delivered the widest intersection to date, 37 meters of composite mineralization in a single hole. 6 of the first 8 holes intersected uranium. Continuity has now been outlined over 300 meters of strike, and a new mineralized structure is identified a full kilometer away. The mineralization is basement-hosted and vein style, similar to Athabasca basement deposits, and the discovery remains open in all directions. These results come from ATHA's largest program to date, 20,000 meters of drilling with 3 rigs through the end of September, supported by airborne geophysics generating additional targets. For investors, the key takeaway is scale. The Rib corridor runs 18 kilometers, Lac 50 runs 21, and nearly all of it remains untested. These are early gamma readings rather than assays, but a junior intersecting mineralization on this many targets this consistently points to genuine district potential.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to the latest developments shaping the uranium fuel market and its role in the global energy landscape. Sponsored by PurePoint Uranium Group. While our passion for the sector is undeniable, nothing discussed here should be considered investment advice. Our mission is to provide a clear, balanced view of the forces influencing uranium prices and the nuclear fuel cycle. For deeper analysis and market briefings, visit purepoint.ca. Join us again next Tuesday for another edition of Uranium Spotlight.